Wow, first question, Alibaba. Alibaba will report results this Thursday. So the most important thing to look out for is the conference call at the 8:30 p.m. Singapore time this Thursday.
Yeah.
So, because the management will face a lot of tough questions because the results is expected to be very weak. Yeah.
Mm-hmm. But okay, let me just read out the first question first, and then also maybe I have some further questions. Okay, I mean, I have to read out because I think some of them will be listening. Not just having the video, right? Some of them are just having the voice. Let's say they listen as a podcast. So the first question is: Alibaba is not investable due to regulations. Meituan is latest victim. They don't care about simi capitalism. Only a novice believes they allow free market. So I think before we go through these questions, I also want to ask Master Leong, I think previous quarterly earnings, right? The result wasn't that good, right? But what's your take before we jump into the coming one? Like, have you listened into the earnings call and so on?
Oh yeah, the previous quarter was very bad because of the competition from those live streaming platforms like Douyin and Kuaishou. They are no longer short form video. They do a lot of e-commerce also. So the influencers, they will sell beauty products and healthcare products to their followers. So this is eating up the e-commerce market share of Alibaba. Because Alibaba also do a lot of beauty and healthcare product in their Taobao and Tianmao. Whereas JD is less affected because JD is more of like electronics products. And because of the lockdown, electronics had a boom. So JD, the numbers still holding up very well. That's why people were very disappointed with Alibaba in the last quarter.
Any comment with regards to the regulations? I know these things has come up it's not new, right? It's true the entire year.
Regarding regulation, a lot of Singaporean investors they are new to the Hong Kong market. So previously they invest in the US market. So they are used to the US way of the companies, how the companies and government operate. But actually US and China are very two different regulation and structure. For the Hong Kong and China market, it's like a very strict parent. Anything they do wrong, they will cane their children. They have curfew. Wow, you cannot go out and play. You must listen to the parent. So it's very strict. So last time, Alibaba, they have the 二选一 啦. So if you use Alibaba platform, you cannot use the Jingdong platform. So they use a lot of those very evil method to make themselves very monopoly. That's why they will fine billions of dollars. So China is very strict to them. Whereas in the West, right, it is a very different structure. It is like very free market one. Your children want to take drugs, want to drink alcohol, want to go to school, take gun and shoot people also can. Very freestyle, so there's not much restriction at all. So the West and the East are both the tech companies, they are operating at very different environment. So you have to understand the environment they are operating at. If you're not comfortable with the environment, then you should not invest in this kind of tech companies. Yeah.
But actually also quite interesting because, I think, let's say before the last year crackdown, right? Before this, I think all these tech platforms, they can do almost like whatever they want, right? And then there's little regulations. And suddenly when the regulation come, right, it just like come waves and waves, right? Like non-stop, right? That's why the share price has dropped so much. So it's very, I think from investor perspective is that, all these regulations, although doesn't matter you're operating in US or other places, right? There will be some regulations. It's just the way that China does it is that it comes very drastic. Like even until now, we still don't have much visibility in terms of what they will do next, right? Are you concerned on that?
Oh yeah, because for China, right, actually for them, right, to be renominated, they actually have to go by 5-year one. Their election. So they always have this kind of 5-year plan. And in their new 5-year plan, right, they feel that the tech giants are in the previous 5-year plan, they is like all out for economic growth because their objective is they want to overtake the US. But they realize that this kind of growth, right, actually the common folks are being abused. For example, Meituan is now they are a monopoly. They own 70% of market share. That's why they can keep raising the prices. like those restaurants have to pay a 30% service fee. So now that's why they want to whack Meituan now, because the big tech, they are out of control already. So in their new fire plan, they want to clamp down on big tech and focus more on things like green energy. So every fire, there's a big change one. There's a big wave, a big change. So the way China operates is very different. That's why.
Yeah, actually, just for your information, I personally own Meituan. I actually did like 1 or 2 videos on Meituan in the past also, and I have owned the shares for quite some time now. I think like around 1 year or so plus lah. I don't remember exactly. And the recent news also is quite, I wouldn't say that shocking. It's not like very new, like just that I think from investor perspective, at least for myself, right, it's a bit frustrated, like, okay, why this come again, right? Because I think last year they made some changes to say, okay, they have to take care of their employees, they have to take care, I mean, those delivery guys, right, cannot force them to to meet the delivery within short period of time, give them some leeway. And then now comes to the merchants, right? I think the question is more like, okay, now it's talking about merchants, then what's next, right? Because if they keep on screwing Meituan like this, right, how does the companies make money, right? I think their fair value could be zero if there's no profit margin for the foreseeable future, right? What do you think on this?
For this year, you will see that a lot of big companies like Meituan, Alibaba, Tencent, they will have to sacrifice their short-term profit to help boost the economy. Because in China, the economy is slowing down. Like last quarter, the GDP is only 4% growth. Well, usually it's like 6 or 8% growth one. So this quarter, if they don't do anything, the GDP for the quarter might slow down to just 2 or 3%. So they are, besides lowering their interest rate and rolling out those a lot of like loose monetary policies, right? They also want the big tech to help the small businesses. Because in China, example, the small restaurants, there are millions of all these small restaurants. And because of Meituan, right, Meituan is eroding all their margins. In fact, a lot of them are loss-making due to the lockdown, all this. So in Singapore, right, when we have the lockdown, we will give what? Rental rebate. So it's the government take cash and hand out. In the US, during the lockdown, they give, like, you're unemployed, they give you free cash handout. In China, they don't give free cash handout. Instead, they want the big tech to be the one contributing. So the way China and US and Singapore operate is very different. That's why investors don't understand this and they feel uncomfortable. For Meituan, this year, they will have to give in. But in the longer run, they will earn back the money. Yeah. So short-term negative, I feel, is just...
Yeah. Let's say if we compare Meituan with Alibaba, right? Because if you look at Alibaba, they are so profitable, right? They build the ecosystem, they build the platforms, everything, and they've been, milking from the platforms because via advertising, these are all considered lucrative business for them, right? So they are, you can see it from the financial statement, they are making money. And if that's the case, right, if government push them to say, okay, you should take care of your merchants, you should take care of your employees, and then reduce your profits, that's still like, okay, reasonable, right? Just treat it like a percentage goes to the donation, right? But for Meituan, if you look at their earnings, right? If we just look at the most recent quarter earnings, they're actually operating at a loss. So I don't know, like, if keep on pushing them, what do the government expect, right? Are they want to like force this company until like can't make monies and need to raise capital from the shareholders, which they did, right? They raised capital, I think like last year, not too long ago. They raised, and then Tencent also participated in the raising round. So it's quite interesting because it's not like they're milking so much until they are making fat profits, right? Still they want to bash them. So I found that quite interesting. But for Alibaba, okay lah.
Yeah, for the CCP, right? Like last year, we saw a lot of fines, but they know that they can only fine one time. If you every year also fine, of course they will go bankrupt because they cannot raise money indefinitely. Right? So yeah, they already have they took the fines last year. They also increased the tax rate. So last time the effective tax rate, because these tech companies, they got preferential rate, they only pay like 10% tax. But now all of them, right, their preferential tax treatment already all over it. So now they're actually paying higher taxes of 20%. Since last year already like that is. That's why for last year and this year, you will see that earnings or will be more depressed. Then for those that are loss making, That's why, for example, like Pinduoduo, JD, and Meituan, they used to be all loss-making. So now they are changing their strategy. Instead of blindly burning cash to capture market share, they must now think of how to deliver value, how to control their costs, how to be more lean and more efficient. So you will see that Meituan, Pinduoduo, even C is the C Limited, or they will stop burning cash, or they will shift their model towards capturing a higher margin products. Example, Meituan, their delivery is loss making, but what they earn is for example, booking of travel or booking of a gym. Those kind of activities, their margin can be up to 30 to 50%, which is actually quite high margin.
Yeah, we also see more, let's say, spending in R&D, and also, those activities that will make the government happy. So, for example, like all the autonomous driving, right? I think they are, maybe if there's any result on this front, hopefully they will have more all these efficiency gains. Okay. Anyone else have any questions with regard to first questions? I think we touched on a little bit on like capitalism, all these things, right? Anyone have any questions or any comment? If not, then we just follow the questions here, okay? Second question is, Cathie Wood is not making much sense in recent interviews and behave like a day trader instead of having 5-year horizon exclaim. Is this a worrying and sell sign? So I don't know how much you follow, Master Leong, on Cathie Wood. Do you have any comment on this?
Cathie Wood, actually, I believe that she's an expert investor because she's already 60 over plus. She's been in the industry for I think 4 decades already. So she's definitely an expert. She's not a noob. But then her strategy for growth investing, like she often says, is a 5-year horizon. But now the market is very unfavorable to her because interest rates are going up. Then high growth tech like Palantir from $40 dropped to $10. You cannot blame her because during different times, different type of investing will perform. Like example, the past few years, value investing definitely underperformed because everybody buy the growth stock. So if you are a value investor, everybody will say you are lousy. Then now this year is high growth stocks underperform. So everybody say the Cathie Wood is lousy and that she is doing everything wrong. So it is not her fault. It's actually the market conditions are like that. So that's about it.
Yeah, I think also depends on like the names that she selected, right? Because there are some companies, when she invested, it could be like loss making, and then after that it become like earning money, right? I think one good example is Tesla. You see there are many smaller names that drop quite significantly, but Tesla still holding up the value, right? I believe if they haven't turned profitable and still stuck at like loss making, I think Tesla will just fall together with other names, for example, like all those Roku, Palantir, these type of names. Or at least that's my observations. Ultimately, we still need the earnings to support the company's share price. Anyone invest in Cathie Wood? Because I think these questions related to Cathie Wood also quite appear here quite often. And I see Gavin here as well. Do you have any comment with regards to Palantir or not?
Hey, hi, good morning. I want to comment on Cathie Wood because I've been noticing a lot of people have been asking and talking about it. And I also think it's very weird because if you have a long-term time horizon, let's say 5 years out, the companies that she picked seems very good. And her bull thesis all sounds very nice. So if the price keeps dropping, why are you selling at the bottom when you should be buying more at the bottom? If you believe in your own thesis, that's my take on it. And it's very weird how she's selling all of her higher conviction ones first, rather than her smaller position. So I'm not sure, is it there's some fund requirement that she's following that cannot cross certain percent, or she must have minimum number of holdings or something that's restricting it. But her recent sellings has been very weird. The previous one where she sold Zillow, that one was still understandable because company direction has been changed, and then so on and so forth. The thesis her bull thesis might not be as relevant, but the Palantir one really didn't make sense to me. The recent earnings were fantastic.
Do you have any comment with regards to the share dilution?
I think someone shared a video earlier today, right? The one made by Jonathan Ang, the Geng Invest. I think his video is pretty accurate. The numbers there tally up. And if you watch the video, he mentioned that the dilution moving out until 2025 should be around 5%, and then thereafter it should be about 2-ish%, which is the numbers add up lah. You can go find all the numbers out in the annual report, and then you can like make rough estimates. Like let's say, I think the number was there would be another 60 million. There's another 166 million in RSU that's still unvested over the next 3 years, and then we can be conservative and assume that every employee like Palantir a lot, they will vest all their stock options and all their RSU. Then you just take the number, divide over 3 years, and then you can roughly estimate what's the yearly dilution. Or you can just watch his video lah. The numbers are very accurate. So yeah, dilution wise, I don't see it being an issue since day one, because the dilution has always been a one-off thing because of the listing. And through most of the earnings call, the COO has also answered this question that dilution would fall off significantly in 2022 onwards, because it's just a one-off incident. Yeah.
Yeah, actually, I haven't watched that video, but I'm a bit like split between these two view, right? Like the first one is I look at their quarterly earnings also. That seems at least year-on-year comparison, we can see that the stock-based compensations has reduced. I think that's definitely a good sign. And then I also think that if we look too far, like early in the phase, right, there's listing, all these things, that's why the share outstanding shares increased. That one's also understandable. But there's another part which I think Master Leong also mentioned, right, which is that okay, if the employees are paid in shares, I think that's fine. Outstanding share increase, that's fine. But why are they selling, right? Because if they are getting the shares and then they do foresee that like dilution will not be a problem and the companies will make more money in the futures, right? And the share price already, like, this is not like at $35, right? It's already dropped to like almost like the IPO price already. Why don't all these insiders just keep on to their shares and wait for the share price to go up? Why are they selling, right? If you look at the insider tradings, right, I think most of them is like all sell. You don't see any buying. So I think that's a concern.
Regarding this, right? So this is very common in tech space, especially in startup space. So the train of thought is this: let's say if you join a Silicon Valley tech startup, your total comp will come with salary plus bonus in terms of RSU or share-based compensation, right? So let's say you have joined Palantir for maybe 5 years, and then you have all these RSU and stock-based compensation that's technically your bonus. So this is your bonus that you're supposed to be like collecting for the past 5 years. So now there's a chance for you to start reaping the rewards and enjoy your bonus. Wouldn't you want to do that? Because it's the same thing as receiving your bonus every year, just that this is a delayed version of it, where you only get it, after the stock has listed, and then now you can finally sell and then finally get to enjoy the bonus that you were sort of granted in your total compensation. So it's not that, they are selling means they are losing faith as an employee, saying that, Palantir is going to do badly, that's why we're going to sell now. But it's more of, I worked for the past 5 years, and then this is my supposed bonus. I want to start enjoying my life now and start realizing back these bonuses that are supposed to be my total comp. So of course it goes both ways. It can be interpreted as both ways, but this is how tech startups work. And it's very, very common to see employees selling out, even though they know the business will do well, because they want to start enjoying life now. You work for the past 5 years, and let's say maybe 30 to even 50% of your total comp is tied up in your share-based compensation. Now you got a chance to start enjoying it. Of course, you will want to start taking out a bit, right? So that's the train of thought lah. But it can definitely go both ways.
All right. Thanks for the comment. Okay, I think anyone want to comment on that? If not, we proceed to the next question. Okay, no comment. Is it the time to all in growth stocks? Any view on this? Growth versus value. We always have this debate, right? Master Leong, you want to comment on this?
Actually, I think
yours is even more interesting because yours is valuing growth.
Yeah, to me, actually, growth and value is the same thing. You just want to buy good companies when they are trading cheap. Let's say you believe in Palantir. I don't understand Palantir, so I don't buy the company. Let's say you understand Palantir, you know it's a good company. Do you want to buy Palantir at $40 or do you want to buy Palantir at $10? So the answer is obvious, right? You want to buy when it's cheap, right? So for ARKK and Chinese tech, both of them, they are down 50% already. So do you want to buy them at full price or do you want to buy them at half price? But of course, you may not want to all in, so you might want to split your bullet. So you buy a bit now, then if it comes down lower, you buy even more. So it's up to you how you want to arrange your funds. But generally, I think now in the market, there are a lot of great companies that are selling at very low valuations. Then you have to pick the right companies that you believe that 5 years later, it will still remain a good company.
Yeah, for sure. Anyone want to comment on this? Like, what's your strategy? Are you shifting given the price change? My personal view on this is that I do see that when we say growth stocks, maybe not referring to companies like maybe Palantir. I don't know maybe there are quite a number of companies that drop very significantly especially those related to Cathie Wood. Like for example, like I look at Zoom price, right? I mean, initially we say, okay, because of the COVID, their share price has went up, right? That was like March 2020, right? And then now, actually, if you look at the chart, I think they dropped back close to that level already. It's as if like the entire COVID, all this like working from home kind of situation has zero impact to the company at all, So it's quite interesting to see like how like all these companies that was seen so good last year, right now it's being punished so badly.
Yeah, for example, like people think about growth stock, they think about those non-profit high growth stocks. So they are actually also profitable growth stocks. Example, Netflix and PayPal, which they benefited a lot due to the pandemic. So for example, Netflix, during the peak, it was $700. And the results, right, because the subscription growth slowed down a lot. So people feel that Netflix is becoming more matured. So Netflix actually crashed 50% from the peak. And the low was $350. So when a high growth stock suddenly trades at so cheap, 50% discount, even a value investor like Bill Ackman came in to buy a big position into Netflix, making it one of his top 10 positions. So actually, growth and value is actually in line one. You just want to buy good companies when they are selling cheap. So you have to ask yourself, let's say you all along you use Netflix, you understand Netflix, this company, you believe that their business model can make money. So do you want to buy Netflix at $700 or do you want to buy Netflix at $350? Yeah, so the thinking should be around this line. That's
Yep, totally agree. I think that Netflix is interesting. Can look into more details. I have some very, very small positions now. But there are also, like you say, right, so many opportunities right now. Anyone else want to comment on this? So the floor is open. If not, we go to go ahead, please.
Anyone? I just checked online that the PE for Baba is around 16. Is it correct?
The P for Baba is 16. Is based on the trailing 12 month. TTM is trailing 12 month. The PE ratio will look higher because they had a big fine in the recent work year. They paid the $1 billion over USD fine. So their earnings is actually depressed. But the forward earning, the next work year, they are expected to make about $10 per share. So if on a forward basis, let's say now it's $120, then it's trading at about 12 times earnings. Yeah, but as a large tech company, the PE ratio for Baba is very low. Because generally, like big tech, they usually trade at like 30 times earnings, or even they are on the lower end also 20 to 25 times. So it is trading at very, very depressed valuations as people, they all don't like Chinese tech stocks. Yeah.
Okay, thanks. Then also I noticed Facebook is around 14 plus. So is it is it 14 plus? Is it, or is it
Facebook is trading at about 15 times earnings. But Facebook, the peak, it actually almost dropped 45% from peak already. So Facebook almost half price. So big tech company, those FANG stocks, so usually in the bull market, they trade at about average 30 times earnings. And now Facebook now trade at half the valuation because people are very negative on the metaverse. They plan to burn $200 billion on metaverse. Every year they will burn 10 to 15 billion on metaverse. So people are pricing it as very negative. Same thing as Alibaba. They don't like Chinese tech. They don't like metaverse. They think that these two companies are very risky. That's why the valuations are so cheap, half price to their historical valuations.
I see. Actually, why are people so pessimistic on the metaverse? Isn't the metaverse, supposed to be the next big thing that's gonna, take Facebook into the future or something? Yeah. Why are people so, negative on this?
So basically, metaverse, right? They will burn 200 billion, but whether they will succeed or not, the future is unknown. Then Mark Zuckerberg say, the metaverse is actually 10 years later. You don't know, 10 years later, there's so much uncertainty, and investors, they don't like certainty. Investors, they want 包价one. They want Apple, Google, Microsoft, because they know every year they will generate a lot of cash from their businesses. Whereas metaverse is more like a startup. Startup, there's two outcomes. They put 200 billion, right? If metaverse fail, the whole business unit is worth zero. So it's 100% loss. Then if the metaverse succeed, it can be worth 1 trillion. So it's like buying Toto like that. You don't know whether it will become big or it will become worthless. So people don't like this uncertainty. That's why they sell off Facebook.
I see. So I guess they don't see this as R&D. Like people when people talk about growth stocks, they like to talk about, the company is spending money on R&D. Then why don't they see this as R&D? I understand it's like Toto lah. You're right.
Yeah, because Facebook, they don't have a track record of developing their own product. Example, let's say Apple, right? They themselves develop the iPhone. So when Apple announced they want to go into EV, then to do an Apple car, investors are positive. They will buy up Apple shares because Apple has a track record of developing their own products very successfully, of innovation. But Facebook, they have no innovation track record. Mark Zuckerberg, they actually copy the Facebook and kena lawsuit that they copy the idea there. They go for settlement. Instagram, they did not R&D and created Instagram. They bought Instagram. WhatsApp, they also did not invent WhatsApp. They actually buy out. So Facebook, they have a track record of buying up other competitors. They don't have any track record of innovating and building up their own company. That's why the investors, they are not confident that Mark Zuckerberg can start up and create metaverse from scratch successfully. So the risk premium is very high. They feel that it's very risky. Whereas, example, if tomorrow Apple announce that they want to go into metaverse, I think Apple will go up.
I see. I understand. Thanks for your insight.
Yeah, I think the hardware is definitely not their the area that they are strong at. But on the software side, even though you can say they are copying the features, right? For example, like the Instagram stories and also some, all these podcast features, right? I think this one, as long as it's on the software side, I think they are still very good at it now. Even if it is just like copy, it's not like everyone can copy the same, as the same quality or even better, right? But Facebook have that ability. So I think they still have their strength there. But I think the worry in terms of like how this entire metaverse will look like is still very uncertain, and how to monetize all these things is still very uncertain. That means you have to look very far ahead and have very strong convictions in order to invest in Facebook. I think that's fair to say. Okay, I think we have a couple of questions that I think maybe a bit challenging to answer. You see, there are two questions for Master Leong, one for me. We'll go for you first. How come Master Leong failed to be indexed for so many years? And the second question is, why does Master Leong call himself master? He can't even beat the index. I mean, before we go into this, Master Leong, I just want to say, people are asking questions using anonymous, so don't take it too personally. But I mean, for me personally, I am still curious, like how do you get this name of Master Leong, and do you want to comment in terms of your performance? Thanks.
Actually, I quite often answer this kind of question because I've been in the online space for 6 years already. I used to post in the Hardware Zone forum, and I used to post on the investing note also. So over the past 6 years, right, I have always shared my portfolio openly. When I share my portfolio, I just put the screenshot of my trading account. So a lot of people know that my portfolio is real. The thing is that when you see online guru, right, they just want to, a lot of them, they want to sell you calls, or they have their agenda. So they will show you maybe their Excel spreadsheet or their website. So all of them, if they don't, especially those that want to sell calls they will tell you that they beat the market. Wow, they outperform the market. Every year they also make money. So you want to believe them or not, up to you. Then I do not claim to be an expert. I'm a value investor for the past 13 years. Then the name master is not I give myself one. Actually, I come from card gaming industry. I used to be a 4-time national champion in a game called Magic the Gathering, a card game. So in the Magic the Gathering, people call me master. So I use back the same name in the investing community. So I hope you all don't mind. But it's just more like brand recognition. To be honest, I'm trying to build my own master brand in the investing community to be more recognized. Then for the past 1 year, right, I've been super underperforming due to my position in Alibaba, and I'm not afraid to hide. I'm sitting on 30 or 40% paper loss on Alibaba. I just show the world. If people want to laugh at me, then laugh at me. Then if people laugh at you, then you feel fearful, then you think you are wrong, you sell out all your shares, then that's even more wrong. So in the market, you should not be affected with noise. If you believe the company, you just hold on tight to it. Then in the long run, if you believe your method works, then it will work. Then in the past, let's say last time, during the property cooling measures, Propnex was sold down to 40 cents. I bought it at 50 cents. Everybody say, wow, property cooling measure. Propnex, sure die. Nobody want to buy property already. Next time can buy property online. No need agent already. Then, so I was sitting on big paper loss on the Propnex, 20% paper loss. And people say, you pick this small cap stock, it's very risky, cannot make it. And you remain depressed for 1 year. And today, Propnex is over $1.50. The same thing for DBS. Last time I buy DBS at $20, then it fall to $17. People say DBS will go to $10. So in the end, today, DBS is $36. So in the short term, as a value investor, you will look wrong, because as a value investor, you are buying stocks that nobody wants and is very hated by the market. So in the short term, 1 or 2 years, everybody will think you are wrong. But in the long run, whether you can make money or not, you have to stick to your strategy. So that's about it.
Boon Tee here. The question is, how come you fail to beat the index for so many years? So the question seems to insinuate that you lost to the index for many years. Is this true, or otherwise? Will you comment?
Actually, for me, personally, last time I checked I've been investing in the market for about 13 years. My average annual returns is about 20%. But I do not go telling everyone, wow, I sure beat the index. Because there will be good times and there will be bad times. I've been investing for 13 years, and 3 years I lost money. 2008 global financial crisis, my first year investing, I lost 50% of my portfolio. My portfolio dropped by half during the global financial crisis. Then 2015, I also lost money. And another year I lost money was last year. So 10 years I made money, 3 years I lost money. So, but my average returns on average as a value investor is about 20% like that. But actually 20% now for a retail investor is not say very impressive. Let's say Warren Buffett once said that if he's managing a small portfolio, he can make average 50% annual returns per year as a value investor. Then Warren Buffett over the past 60 years, his average annual returns is about 20%. His returns now is lower because he's managing a very big portfolio. But in the short term, you see my Alibaba position, you may think that I'm a lousy investor because I lose so much money on Alibaba. But I don't really care about how people feel about me because I'm still sticking to my same strategy. So that's about it.
You mentioned these Alibaba positions, right? And then just curious, is there a price, let's say it rebound, right? Hit certain price, will you like sell your position? And what's the price that you are looking for to entice you to sell?
So as a value investor, you want to buy when it's undervalued and you want to sell when it's overvalued. For example, you keep seeing me talk about Alibaba. Let's say tomorrow, Alibaba or Monday, Alibaba open $500. $500, I will sell everything already because it's overvalued. But I think Alibaba now the fair value is about 20 to 25 times PE ratio. So let's say it can make $10 per share next year. So the fair value could be 200 to 250. So if Alibaba trades above 250 and I see that Facebook is still undervalued, I wouldn't mind selling some of my Alibaba shares, which is fairly valued, to buy more Facebook shares, which is undervalued. So it depends on the situation and depends on if I got any other better choices. Yeah.
Okay, so the price that you're looking at is between like 200 to 250.
Yeah, I think Alibaba, the fair value is about 200 to 250. And now it's trading at half price to its fair value. That's why you will see investors like Charlie Munger, double down on the Alibaba. Same for me. My portfolio 99% is Alibaba. I have spent about over 300,000 Sing dollar purchasing Alibaba. I'm all in Alibaba and it's 99% of my portfolio. And a lot of people are feeling very stressed, very worried. But you see, I put 300,000 on Alibaba. I also don't feel stressed or feel worried. What I believe is a good company. The 20% of the market cap is in cash. It will not go bankrupt. So I am sleeping very well at night. So in the end of the day, it depends on your mindset also.
You mentioned about the margin also, right? Actually, is there any update on that situation? Like, is there a price that you are watching closely? Let's say if it falls below, you will be liquidated, sir.
I mentioned before, I use margin. I'm 1.5 times leverage. Also, by putting 300,000 Sing dollar, right? I actually leveraged 1.5 times and bought 13,000 shares of Alibaba on the Hong Kong market. 13000. I have 13,000 shares of Alibaba on the Hong Kong market. So if the price falls too low, example, I calculated if Alibaba falls below $100, I will face a margin call. So I might need to sell like 1,000 or 2,000 Alibaba shares to reduce my position to 1,000 to 10,000 or 11,000 shares. So I will face a margin call if Alibaba drops too much to below 100. But so far, it doesn't seem to be falling that much already because it tests the 110 support level 4 times and did not break. So it seems that I'm safe so far. I'm not facing a margin call. Then secondly, why I want to use margin? Because like you see the Daily Journal, right? Charlie Munger mentioned that for the Daily Journal portfolio, they actually went 20% on margin. Their total asset under management is 200 million. They actually borrowed 40 million. They went 1.2 times leverage to purchase Alibaba. And the shareholder asked Charlie Munger why they do so. Because they feel that holding cash, you are losing to inflation. So they rather take a risk by borrowing cheaply. When you borrow, but one thing he never explained in detail is that you can actually go negative cash. To be negative cash, you actually borrow money. So what I'm doing now is that I don't want to hold cash, because if I hold cash, let's say I go 80% of my portfolio in stocks, 20% in cash. The 20% in cash will lose 5 to 10% value per year to inflation. But when you go on margin, when you're on leverage, right, you are actually negative cash. So you are benefiting from inflation. For example, if you can borrow at 2%, then your inflation is 5%. So you're actually making a gain. But this is an advanced strategy. So I do not recommend new investors to go negative cash or use margin. So those who do not understand this strategy, they will feel that margin is very risky. But actually what Charlie Munger and me, we are trying to do is that we just want to hedge against inflation. Yeah.
So let's say if the price, I mean, for whatever reasons, right? Let's say the price really dropped to $100 and then $95, right? And then you are facing margin call. Do you have like cash outside that you can tap into just to make sure that you are not forced to liquidate, right? Do you have such liquidity outside, or you are ready to say, okay, if it really dropped to that level, then so be it. I will just let the broker like liquidate the position in your portfolio.
Oh, actually, to be honest, it can draw down cash. What I do have cash ways to like borrow money or what. Example, you can just go to the bank, you just take unsecured borrowing. You just borrow from the bank 30,000 or what. You can borrow from relative or what. So you can borrow to, or you can find, or you can sell other assets to just top up. But for my view, that if drop below 100, right, I will just reduce my position, or I will just sell 10% or 20% of my Alibaba shares. Let's say from 13,000, I will just sell maybe 2,000 shares to reduce the position to 11,000 shares. Then I won't face the margin call. So there's two choices. Either you top up cash or you reduce your position. I am comfortable reducing my position. But that's why when using margin or you want to use this so-called advanced strategy, negative cash, there is a lot of risk involved. So for those who do not understand what they are doing, they will feel very stressful. But for me, I already plan out the different scenario already. So if anything happen, I will know what to do. Then I won't feel so stressed. Yeah.
Okay. Thanks for the detailed sharing. I'll just look around, see if anyone has any more questions for Master Leong, because I think there are some other questions for Master Leong. I just want to pause here and look around.
Martin here. Just curious, Master Leong, you're only doing investing full time, or you got a full time job as well?
Oh, for me, actually, I'm retired already. My age is about 40 . So I used to work in the bank as an equity dealer. I also used to be a professional card gamer. I play online poker. I also play Magic the Gathering card game. So over my past 4 decades, I managed to build up some assets. So now I'm just leading a very simple life. My monthly expenses is just 1,000 plus only. I'm not married, don't have any children. So I'm so-called a full-time investor come retiree. So I just do YouTube and the Substack to pass my time. So because card gaming, I'm already out of my age already. So in my 20s, in my 30s, I can be a professional card gamer. But now in my 40s, right, I'm too old for the gaming already. So I become more focused on the stock market, educating people and own self investor. So that's about it. Yeah.
Oh, correctly. Thanks, Master. Thank you.
Yeah, your YouTube with all the YouTube shots is definitely very impressive. I look at the number of shots that you are generating, right? It's like, wow, really? You can just speak naturally, right? You just record and just do your, talking, right? You don't really need preparations.
Yeah, I don't use, people ask me, I got use script or not. I don't use script, man. It's just 1 minute talk. Because I used to work as an equity dealer. So my job actually was every day pick up the phone. When I pick up the phone, the customer will ask, oh, today Singtel, what is it doing? Can buy or not? And then rich people, right, they have a lot of money, but they don't have time. So time to them is very expensive. Within 1 minute, you must tell them whether what happened to the stock, can buy or not. So example, if Facebook dropped 25%, the customer will call, hey, what happened to Facebook? Then you must tell them what happened and whether if they're holding Facebook, they should sell or they should buy. So every day, last time my job is pick up the phone and answer the customer. So now I'm doing the same thing. The YouTube, the 1 minute video is like, example, you are a customer, then what happened to Facebook what night? That night, and in 1 minute, I have to explain to you everything. So that is my style.
Yeah. That's definitely interesting. Okay, I think now it's my turn already. The next question is, how come Boon Tee kept selling stocks at low prices whenever a stock dropped? First Facebook sold, and now Alibaba needs some clear advice as to why he sell. So I think this question is for me. Yes, I think we discussed Facebook, I think 2 weeks back, since the recent earning release came out. And then I think we also discussed quite extensively in terms of their earnings, in terms of their, all these monthly active user drops and the concern and so on. And then I think I have explained quite well I mean, in details at least, like why I decided to sell my Facebook. So it is not like a huge position for me anyway. So I don't have like very strong feeling. It's just that, look at the situation now. I mean, my main concern is still come back to the products. I mean, by just looking around, especially look at young people, right? Are they using Facebook products? So with this kind of backdrop, right, looking at people moving into other platforms, right? So I do think that there's some concern with regards to their user growth. So to me, I just think that, okay, if I don't have that conviction, I shouldn't hold that position just because the share price has dropped, right? So I just liquidate my position and move on. So I'm not doing market timing. I just want to assure I don't look at the chart. Most likely, I spend more time to look at the business. So, and also I don't my style is not like looking at the price and then see whether they are undervalued relative to the share price or not. I don't do this kind of things. I want to own companies that is like having better future that can ride in the futures, right? So I think that's my style. So that's on Facebook. And then the next one is on Alibaba. This one, I think similarly, in terms of allocations, I only have 2% in Alibaba. And then, in the past, right, I started to buy Alibaba actually before they talk about NIPO. So that was before the crackdown. End of 2020, I already have initiated my position, and then I added my position in 2011. So I built up my position over time now. Entire this crackdown, I haven't really sold my position because I always thought that, okay, yes, sentiment is bad, but I look at the fundamental of the business. I think that they are still solid. Even though like we look at the recent earning report, right, it's not fantastic, but that's most likely because of the competition and also the general economic also not doing very well in China. So all this I can tolerate now. But the part that I mean the reason that I'm selling, because I actually quite, how to say, like I was undecided on whether I want to share more on this because like I heard there's some rumor of further crackdown on these companies. But the tough part is that I don't really have any evidence to share. Like let's say if someone just to share some fun news, fear, uncertainty and doubt, right? This kind of news, right? I will, in the group, for sure, I will be the one asking like, can you share your evidence or any source that you are reading so that we all can judge the situation, right? But for Alibaba's situation, it's a bit different because I don't really have an evidence, nothing concrete. But to me, it's just that look at the situation. It seems that there will be further crackdown that's coming. So that's why I think that, okay, given that I don't really have a strong position and strong conviction, right? So I'll just exit now and move my position, move my monies to other companies that I have more conviction on. I'll think about it in terms of which investment that I will move to, and then I will update you all. So I think that's a short answer. I know for Alibaba, this one, you may not be satisfied with my explanation, but I think that's all I can give. I can't comment too much on this now. Okay, but please be assured that I'm not spreading fake news or anything like that, and I don't have any insights with regards to their earning release. To me, it's always like, okay, it could be 50-50, right? It could outperform the estimate or it could underperform, right? I really don't have insight on that now. And with regards to fundamentals, everything that Master Leong just shared, right? I very agree on the assessment now. So no problem on that. Don't read too much into my buy and sell because given that this is a very small positions now. So I think that's comment from me. Any questions? Anything that you if you are not happy, you can ask clarification questions. No questions means satisfied with my explanation. Yeah. Okay, let's move on. I think come back to Master Leong again. How come Master Leong say he long-term plus value investor, but his video every day talk about price movement? You want to comment on this?
First of all, talk and action is different. Like, you look at my portfolio, which I post on my Substack, only members can read. I've been holding Alibaba for 1 year already, and most of my position, like in the past DBS or Popnex, I usually hold my position 1 to 2 years. But why my YouTube talk about day-to-day stock market is because that is what the viewers and readers want. Then you always see I got the Bird series, like Bird asks if Palantir can buy or not. But ask if the C Limited can buy or not. Because I always get the same thing, also questions from new investors, whether this stock can buy or not, what will happen. So the video is catered to what the audience want. The audience don't want to hear, today is just ask you to buy this stock, hold for 2 years. They want to know what is happening, whether can buy or not. Like Palantir dropped from $40 to $10. People will ask, so what is the fair value? Then what is the outlook? All this. So for video wise, it is more short term, but that's because that's what the audience wants.
Yeah, I can definitely share that the topics that you cover on your YouTube shorts, those are definitely very engaging content. I mean, for those who don't really follow markets on like hours a day, right? Definitely they could benefit from your update. Okay. Next question. What is considered a long-term hold to have a huge chance of making profits? 1 year, 3 years, or 5 years? You want to comment on this?
I think investing nowadays, people are very like sentiments, emotional driven. Like you see last year, 2021, a lot of new investors open Robinhood account, open the Tiger and Momo account. All of them, they rush to buy the high growth stocks. Then this year, they cannot burn. Then now, what is happening now is that a lot of people, they are selling off their shares and moving into cash. Like you see on YouTube, the Meet Calvin, he has 1.8 million followers. Then he sell everything into cash. Then he also encourage his followers to sell everything and move into cash. So what basically what they are doing is they are trading, which is actually making like casino like that. They bet up or down in the short term. So whether in the short term, up or down, it's 50-50 Just like you go to the casino, you bet red or you bet black. Sometimes you will win, sometimes you will lose. But if consider whole long term, is example you dollar cost average into the SPY. Every month you put $500. Every year you put $1,000 into the stock market. And in order to 100% make market, right, and make money, right, you have to dollar cost average for 10 years or 20 years. So 10 years or 20 years, then it's considered long term because you're investing into your retirement fund. So every month you put 1,000 to grow your retirement fund. Then that one is considered really long term. Yeah.
Thanks for the comment. Yeah, I also think the same, right? Because, when we say invest for the long term, it's not really like buy one position and you lock yourself and you don't liquidate at all, right? I think it's more on like when you decide on your buy and sell, it has to be based on like long-term considerations. So in order to ask what is long-term, you need to know like what is short-term, right? For example, if you are looking at chart, you look at some pattern forming and then you say that, okay, it looks bearish and I just want to let go of the stocks, right? I think that kind is really short term because your view on the chart will change every couple of days or even a couple of weeks, right? It will change, right? So this type of assessment is really looking at the short term now. But for long term one, I would say usually we look at the business. So if the business is doing well, and then you understand like why the business is doing well, because of their services is good, culture is good, product is good. This kind of assessment will be longer term. And if the business deteriorated and you just decided to sell, right, making a long-term assessment, then you decided to sell, I think that one is still considered a long-term approach, right? Because the deterioration might last long-term, That's why you don't want to stuck in that position and you just sell, right? Even though you might just bought into that position for like 3 months or 6 months, right? It is fine to sell as long as your outlook, say your long-term outlook is telling you that this is not a long-term hold positions. So I think please differentiate like the difference between the holding period and the consideration that you put in, whether they are long-term consideration or short-term considerations. That's the only distinction I want to make here. Any comment? If not, we move on, yeah? Okay, next question. Why is someone talking like an expert about DBS when his one stock portfolio is performing so badly? Who is talking about DBS? I'm a bit curious, like why is this question?
I think they're shooting me again. Because yesterday I talked in the group chat about DBS. People ask me, DBS now at $36, what is my view? So I shared my view on DBS. Because previously during the 2020, I bought the DBS at $20.50. Then subsequently I sold it off at $30. Now it's $36. So $36, what is my view on DBS? DBS, if you want to hold it as a dividend stock, it is still reasonable. It pays a 4% dividend yield. If you want to sell and take profit, it's also reasonable because it's trading at 1.7 times book value. So it's either fairly value or overpriced. You want to take profit and move to the US market, also can. Then they commenting on why I talk about DBS when my Alibaba is deep in the red. So my Alibaba deep in the red. But at the end of the day, if no one is perfect one, cannot be that your portfolio is always green. Cannot be that every time I buy a stock, the next day it will go up. Then all the way is green all the way. As an investor, right, half the time you will be sitting on paper losses, especially on your new position. When you initiate a new position, it can go down or it can go up, half. But whether over the next 1 year, 2 year, 3 year, whether the company can it grow its earnings and the stock price go up or not, then that's another thing. So that's about it.
Yeah, thanks for the comment. I also don't know how come there are so many people giving all these very negative comment to you. Do you have many?
I got a lot of haters. That's why.
Why is the case?
No, because last time on Investing Note, in 2020 and 2021, I was very bearish on Tesla, crypto, and ARKK. I told a lot of people that I believe it's a bubble and it will crash. So those people who are vested in crypto and ARKK, they dislike me because I always pour cold water. But what I was trying to do is to warn the 5,000 followers, do not speculate on crypto, do not chase those ARKK high growth stocks. Yeah. So now that it crashed already, people even hate me more because they lose money on the crypto and ARKK. Also people even more 讨厌 me. But it's okay, I used to it already.
Yeah, I think it's all come back to what you are comfortable personally, right? If you are not comfortable with that position, then invest in what you know for everyone, right? So don't have to be hating someone else that having a different positions, right? It will be very boring if everyone hold the same positions, right? Yeah. Okay. I think this is not a question, but let me read it out. Should I sell my Alibaba now still at more than 10,000 USD in paper losses? I see Keng and Master Leong underperform index. Don't dare to trust them already. They touch, I exit. Just for your information, I think this friend, he's posting this question almost every week, especially now you're here. I think he just want to share his frustration. You have any advice for someone like this, having an unrealized loss on Alibaba? Yeah.
So at the end of the day, investing is about how much you understand the company, how much conviction you have. You want to hold great companies for long term. But example, if you believe in Apple, Google, and Microsoft, then you hold those companies and you will sleep well at night. But if you hold Alibaba, and Alibaba, you are sitting on big paper losses and you cannot sleep well at night, you feel very stressed, then you just sell out. You sell out Alibaba, buy what you feel is comfortable. For example, you buy Palantir at $20, then Palantir drop to $10, you're sitting on 50% paper loss, then you feel uncomfortable, you don't believe, then you want to sell, then you sell. You buy Alibaba at 200, then Alibaba drop to $110, you feel uncomfortable, you don't believe in the company, then you want to get out, then you get out. In the end of the day, it's your choice. But investing, there are many ways to make money. You can value investing, growth investing, you can sell options, you can trade crypto, you can do dividend investing. There are many ways to make money in the stock market. The most important thing is that you choose the method that suits you and you believe it will work. For example, you believe in Tesla, then you believe Tesla has a lot of growth ahead. Then you buy Tesla at $1,000. Then Tesla dropped 20% to 800. Then you ask people, hey, my Tesla, should I cut loss or not? Or should I hold? That means you don't have the conviction, right? Because if you really believe the company and the same company, the fundamentals never change at all, and it trades like 20% or 50% lower, you should want to buy more because it's still the same company that you believe in. So if you don't believe in the company and it's selling cheaper and you don't want to add more, then maybe you should just exit the position. That's about it.
Yeah, that's definitely true. And don't have to like follow others or avoid stuff that others touch, right? I think this is quite weird, right? Basically, it's all like your own assessment and your own decisions, right? Need to own the decisions. There's another question. Master Leong has good investment mindset, but seriously lack the temperament. Many good investors rarely talk or boast about their investing skill. I think this one also, like, I at least for me personally, I don't observe that much of boasting. I think the comment that Master Leong gave are quite fair. So I don't know like why there's so much. Probably like you said, Master Leong, like there are too many haters out there. You want to comment on this? If not, we can just skip now.
Yeah, because another thing is I offend a lot of community, but my way of talking is I very straightforward one. I do not try to like mince my word or want to pour anyone or say good things. If I believe in something, I will just honestly tell you. Like back in investing, a lot of people, they like to invest in REITs. Then REITs are actually now is falling. So last time I warned them that if interest rate go up, REITs might come down. Then now also REITs coming down. Then in a high inflation environment, let's say your inflation is 5%, does it make sense to collect a 4 or 5% dividend? So people feel that I'm very bearish on REITs. So people don't like me. Then people think, wow, you think you're so smart, you value in investing so pro, but you Alibaba lose money then you still dare to say REITs no good, crypto no good. So people, the human behavior is like that one. People want others to agree with their view that REITs is good, crypto is good. People only want to stick with others that have the same bull thesis as them. They don't want other people to pour cold water at them. But my view is like that. If you come to my channel, right, I will share with you honestly what is my view. If my view is bearish, I will tell you I'm bearish. If I'm bullish, I will tell you I'm bullish. I will not hide anything. I will just say honestly one. So that's my style, which is easy to offend people. So that's about it.
Master Leong, what are your views about rising bond yields and their impact on the stock market? Like, let's say bond yields, maybe next year become, I don't know, maybe 4%, let's say. Then do you think this will be bad for the stock market?
Because I'm old uncle already, I can share my experience with you all during the 2005 to 2008. In 2005, after the dot-com bubble, the rates was very low, 0 to 1%, just like the current environment now. So it created a housing bubble. So property prices went up a lot. So in order to curb but that also led to inflation. Inflation was about 3 to 4% during 2005. So the Feds, they raised rates by 2% per year. So in 2005, rates was raised 25 basis points every meeting. In 1 year, it rose 8 times, 25 basis points, 2% per year. So by 2007, right, interest rate from 1% become 5%. So property went down, risk went down, then the bond yields go up. So like you look at Singapore market, historically over the past 20 years, REITs, generally the average annual returns is about 8%, 6% dividend yield, and 2% is the DPU and NAV growth. DPU and NAV growth of 2% is in line with inflation. But inflation is basically the rising cost of housing and food and energy. So your property should appreciate along with the inflation, which is the historical 2% inflation. So when your interest rate, let's say the 10-year risk-free bond, let's say a 10-year risk-free bond now pays you a 3% interest rate. Investors will demand a risk product like a REIT to pay at least 6% dividend yield because you are taking on some risk. So what happened during the 2008 global financial crisis was the 10-year risk-free bond was paying 5% risk-free. If you can buy a 10-year risk-free bond, why you want to pay fair value for a REIT to collect 5% dividend? Am I right? So you are taking risk to buy the REIT. So investors that time demand 8% dividend yield from the REITs. So REITs during that period crashed 30 to 40%. So the same thing, if now the rates are going higher, if the 10-year risk-free bond goes up to 3%, then REITs should pay about 6% dividend. Also, risk and the interest rate and property, they are all have relationship together on.
Thanks a lot for the comment. So yeah, I know like today this is the first time Master Leong joined the group. I think there are some group members is a bit like overexcited. So I'll just say that I saw that questions keep coming in, but I mean, to be fair, right? I don't do this weekly session and specifically inviting Master Leong to join here. He just like joined our community and find that all this weekly chat is interesting, and he just want to join the session and share his perspective, right? So if you have any things to say or you want to debate any of his point, feel free to unmute yourself and then you can give your perspective, and we are all happy to listen. But please don't keep on spamming the Slido with questions or some haters comments. This is not like a YouTube comment section for you to put all your hates here. Okay, the quality of the discussion really depends on the quality of the questions. So I hope that we all keep the quality high and not to make ourselves don't lower down the qualities. That's all I have to say now. Okay, let's continue with this. So I'll just give a quick comment on this. So the question is, please get real investor to discuss. My advice is don't anyhow invite any Tom, Dick or Harry to talk about value investing. So my comment is this, right? Like this is a weekly show. We all sharing our perspective on an equal basis. I'm not a guru here. Nobody is like a guru here. Or you can say everyone is guru. So we are all fair here. So anyone have any point can just unmute and speak. So this is not like any like investment class or anything like that. So that's my comment.
Boon Tee.
Yes.
Can you hear me?
Can. Go ahead.
Yeah. Good morning. Good morning, Master Leong.
A bit slow. Can you like move the mic closer to your mouth? Or?
Oh yeah. Sorry. Okay. I'm just saying that I really thank for all the sharing by Master Leong. I think he come across as someone who has been through a lot. And I think there's a lot of insight there, and he seems to be humble, sharing his experience. So just a shout out to him to 加油, all the way.
Oh, thank you. Hot lah.
Thanks a lot, Yisman. But your voice still very low. Very hard to listen. Need to get a better mic.
Yeah.
Okay, let's move on.
Wait, can you hear me?
Yeah, now better.
All those anonymous questions were a bit no value. Maybe I think that you should just skip past sometimes lah.
Yes, I'll take your advice. Sure. Okay, move on. Palantir, how I thought a lot of people's pump and super hype now drop like bomb, game over. Yeah, I think this one's similar things. I think we have discussed this in very details. Come back to the same advice again. Don't just read too much into the price chart or the hype, right? You really need to go into the business, understand what they are doing, and then form your opinions, right? You should look at everything, including their business, the management, whether dilution is a problem or not. I think many people has commented on this. You can watch some YouTube video, get a good understanding, and then I mean their business related to government, is there a concern or not? All these things you need to take all this into consideration and form your opinion. If you are bullish on it, then just buy, and as the share price drop, you can accumulate the shares at cheaper price, right? So I think that's definitely good. And if you don't have that conviction and just stay away, I think that's fine as well. So don't really need to like just follow like be emotional about it lah. I think that's not good for your investment decisions lah. Let's move on. Thoughts on ASML moat. Could there be a day where EUV importance be diminished? Will the emergence of 3D DRAM chips reduce the need for EUV lithography? So I think I can comment a bit on this. I think ASML, right? Yes, they have DUV machines, they have EUV machines, but I think the profits, right? I mean, especially moving forwards over the next decade, right? It will still be EUV. The main reason is that ASML is the only companies that know how to make this EUV machine. So if you really like you have like total monopoly of the entire products, right? And every semiconductors companies, right? TSMC, Samsung, Intel, they will need these machines, right? So they have the control over the pricing. So that's where the margin come from. So this is true for now, and it will be true at least for, I would say, 3 to 5 years. And you can look at their investor days. They have shared their roadmap on in terms of what kind of upgrade they will do over the next 3 to 5 years. I think we have clear visibilities up to that point only, because what happened from, let's say, 2027 or 2030 or after, right? Actually, nobody can say, because even now coming to the semicons, right, which is based on silicon, whether you can base on some other substance down the road, right? We still don't know, right? So I think this area is still like moving. I would say it's moving very fast in the sense of things is true now, and then next year it become like obsolete, right? It's not the case. But you still need to be careful that these things we can see up to a certain number of years. After that, it's really depending on the company's R&D to make sure that they stay at the forefront of the technology. So depending on your comforts, and of course you can keep in touch with, stay in touch with what's happening on the technology front, right? And if you see that there's any development to say, okay, maybe these EUV machines become like useless in the future, right? Then of course you can steer your portfolio away from the company. But as of now, talking about 3 to 5 years, at least we can say that it will still be something that is crucial to all semicon companies, and they will still get a huge profits out of this business. The 3D DRAM, I don't know the details on this, but my understanding is that when it comes to memory chip, right, the EUV machine is not really needed. In fact, in terms of the process node, they don't need like those like sub-5 nanometer chip. This one is really for the CPU. So for all the ARM chip, the phone and CPU, all this need the 543 nanometers process nodes. So not so related. I don't think memory chip, they will need such a short nanometers. So I think that's my comment. We can discuss in more details if you have further questions. Let's move on. How to know which high growth but intentionally non-profitable growth stocks is good and will recover? Everything sold down hard, even darlings like C Limited and Palantir. I think my comment is that really can't generalize. I think this one you really need to go into each company and understand them individually. It's very hard to say, okay, this group of companies, software companies or anything like that, right? Generalization is quite dangerous in this sense. But let's say if we go to, I think many companies will say this, right? They will say, okay, actually, we just flip a switch and then we can become profitable. We are investing for the future. I think you will hear all loss-making companies make this kind of statement. Because if they are loss-making now and they just admit that actually we are loss-making now, actually no way that we can turn profitable in the future, right? What it means is that this company's fair value will be below zero, right? So what does it mean, right? So they can't make that kind of statement. But out of 10 companies that say, they just flip a switch and they can become profitable, probably less than half of them is true, meaning that they actually cannot flip the switch. The moment they flip the switch, maybe they can't generate sales or they will lose the business and so on, right? So they can't do that, right? So it's really up to your own due diligence on single company to really understand, can they actually maintain the sales and maintain the profits or even earn more profits if they just scale down their marketing costs or their R&D costs. It's not easy, I can say so. It's not easy to differentiate these two. Even for myself, I can't say for sure, right? And the intrinsic value of these companies, let's say even for C Limited and Palantir, it really depends a lot in terms of their growth and in terms of their future profit margin. So if you are very confident that they can sustain their growth and they can increase their profit margin, right? You just have to do a very simple DCF model and you can calculate their intrinsic value and compare to their today's price, right? But usually because they are very sensitive, meaning that a 20% growth rate with a 35% growth rate can give you a very different intrinsic value, right? So you know that the range of the intrinsic value is very large. So that's why you need to be aware of that. I mean, that's where the uncertainty comes from, right? It's not like the business will bankrupt or anything like that. It's not that case. It's just that the valuation ranges very sensitive to the growth rate and profit margin. Just be aware of that. Yeah, that's all my comment. Anyone else want to chip in on this?
I think when they say that high growth are intentionally non-profitable growth stock, right? I think maybe they are talking about those stocks that have positive operating cash flows, but very high capex. And if they reduce this kind of capex, maybe they will be profitable. Maybe they are thinking along the lines of this.
Yeah, I understand that. But my point is that you don't know for sure, right? It could be that the moment you reduce your capex, then suddenly you don't have business anymore. Yeah. We need to see how they spend the capex and see whether that capex will link to the business overall, right? Because there are stuff that is linked, but it may not be so obvious.
Yeah. And you remember last time I asked you about Amazon during the early years, post the internet bubble boom bust. Yeah, actually, right, at that point of time, you just look at the numbers. Amazon will not be looking so promising, meaning that it doesn't look so cheap either. But 17, 18, 20 years down the road, Amazon is priced a lot differently and the growth is also exponential. So sometimes looking at the numbers is not so easy.
Definitely. Yep. Gavin, you want to comment something?
For predicting whether a company is high growth but intentionally not profitable, one factor that everyone always uses is free cash flow. But another one you can look at is annual recurring revenue and their net recurring revenue, and then you just see if let's say if they really cut down or slow down their aggressive growth in S&M and R&D, is the ARR there to really support all their expenses? That's one way to look at it. But yeah, there's really no guaranteed way to really figure out whether it's high growth but not intentional, non-profitable, or even if they slow down, even if they cut off, they still cannot profit. Yeah.
Hello. Okay. Let's move on to the next question. Where is Daniel? I thought we were going to have a Daniel versus Tesla bull debate. This one, I would just say, not a very easy decision for me, but I did consult a couple of admins of the group and seek for some opinions. But ultimately, the decision is mine. It's just too hard for me to moderate the session with him around. So that's why I just remove him from the group. But between me and him, we don't really like very hard feeling that kind. It's not like I quarrel with him. It's just that it's make it easier for me. So yeah, that's a selfish reason on my side here. But let's say if you reach out to him, and then whether it's on Twitter or any other place, right? And if he's happy to join our weekly session and host this, TCSS, right? We can always have him if he's happy to join. I'm happy to have him. So, but in terms of the group chat, I think it's a bit tough for me. So yeah, that's a short comment from me. Let's move on. Apple, Microsoft, Amazon, Google, to pick one or two, which would you pick now? Anyone want to answer this and give your explanation on why?
Just buy all lah. What if you have to think so much? That means you don't have the conviction. You don't know which one to pick. What? So, in generally, let's say you are a new investor, then you see now market crashing. You're very scared. So you want to find a segment that you feel comfortable and you feel safe, which is big tech companies, because they are not so afraid of inflation. Like if inflation, let's say the price of goods and services are rising up, Apple can increase the iPhone price. Then Microsoft, they're already increasing the price of their services. And Amazon, the Prime subscription fee, I think they raised from $120 to $140. So all these big tech companies, they are able to hedge against inflation. They can raise their prices. So you can just buy a basket of big tech companies and hold for long term, and you should do relatively fine. You don't have to like focus fire and all in one company. That's about it.
Yeah. I think that's the easy part, right? It's not a binary. You can just allocate. And let's say if you have stronger conviction on one and less conviction on the other, you can just scale according to the convictions, right? Let's say you can have like 20K into one company, 5K into another company. That's really up to you, right? Don't really have to make it become binary, you know. But let's say if I want to comment on this, right, I would say Apple and Microsoft, I think they are good. I mean, great companies, but they are also priced, like in terms of pricing, investors acknowledge the quality of the business. The part that I think is more undervalued relative to the others, I think is Amazon. I think mainly it's because of e-commerce. I think in recent 1 or 2 quarters, I look at their result. I also don't think the result is that good. It's really, it's actually bad in terms of their e-commerce business. That's why I do think that their share price has been punished relative to the other 3. But if we look at their cloud business, and I mean, I think the cloud business, right, is still not appreciated enough. So that's why I think this is, if we want to look at the difference between the what is being priced in and what is being what is the true value, right? I would say Amazon is still my top pick. Okay. Any comment? If not, proceed, yeah? How to know which group? Oh, this one answered already. Next one. Thought on just VWRA as a single pick ETF portfolio. Anyone want to comment? For those who don't know, VWRA is ETF that track the FTSE All World. So I think this is the ETF that cover both the developed market and also emerging market. If not, I will just give a quick comment. I think, when people talk about passive investment, right? Passive means that you have a passive view, means you don't have a strong view with respect to certain sectors, specific companies, and so on. And the true passive investment is this VWRA instead of others, for example, like those S&P 500 and so on. The reason is because VWRA, right, they will cover the entire global. So you will expose to almost every countries, not every, but almost every countries now. So this is the true passive one. I think some people, and if you read some comments with regards to comparison of VWRA compared to the others, right? I think the criticism is that they might think that VWRA is underweighting emerging market. So if you look at the weightage, right, I think probably, let's say 90% is in developed market. Let's say out of that 90%, maybe slightly more than half, let's say 60% is in US. The rest are in developed market, excluding US, meaning like Europe, Australia, Canada, Japan, these countries. And only 10% in emerging market. And in emerging market, you have countries like China, India, Southeast Asia, all these list of countries, right? They are only 10%. And because they are, the corporate profitability, I don't know whether it's like very low or what, but it's somehow you just weight based on the market cap. It is like that. So, VWRA, they will just weight according to the market cap float. So that's how it is. I think it's a fair, it is the passive way to do it, right? But for those who think that emerging is underweighted, they will prefer to have, let's say, like the IWDA plus the EIMI, because this is true, right? You separate the developed market and emerging market, and then you can allocate more into EIMI if you have a more bullish view into emerging market, right? There are people who believe that US and developed market is overvalued, so they just want to reduce the allocations. You can do that with 2 ETF. But if you think 2 ETF is just like too much and you just want to keep it very simple, 1 is enough, which is this VWRA. I think this is definitely a sound investment strategy for those who don't have a view. But if you have a view, you think that, okay, I think S&P 500 is better because they have more quality companies, like all these tech companies like Apple, Amazon, right? Then it's also fine, right? Because investing in S&P 500 versus investing in VWRA, the difference is just the excluding US part, which is the companies in Europe, Japan, and Australia, these kind of countries. So I would just advise you just to look at their fact sheet, look at their top 10 names, look at their countries allocation, and just pick from there. A single ETF of VWRA is definitely okay. Let's move on. Name your top pick for 2022. I'll just look around and ask want to point fingers. Master Leong, you go first. I think also no need to ask.
I don't recommend any topic. In the end, depend on your style. But if you want to like low risk, low returns, I think big tech is still the place that you want to park your money. Because be it war or inflation, if your portfolio is Apple, Google, Microsoft, this kind of big tech, you will still sleep very well at night. Then among the big tech that I feel is more undervalued, I share is the Facebook and Alibaba. But these two are very hated and very disliked by most of the investors. So it's a very contrarian approach. But still, big tech is the where you want to hide your money in this kind of times when there's a lot of fear.
Thanks a lot. Gavin, what about you? You want to share your top pick?
My top pick for 2022, tech, it will be tech. Palantir, since it's one of my biggest positions, and Lemonade, watching Lemonade very closely as well. Yeah,
I remember we discussed Lemonade quite in details some time back, right? Okay, anyone else want to share your topic? Just look around, no pressure. Okay, no, let's move on. Okay, this is interesting. Master Leong can tell us who is Bert.
So Bert is any random person, because same as you are, I also face a lot of questions every week. Like people will like message me whether on the Substack or on the YouTube or on my Twitter and ask me a lot of questions. Then I feel that, you see, if you want to communicate one-on-one, every time one person asks you a question, then you reply him back, it's very tiring and it's not efficient to reply private message person one by one. So instead of private message, right, I will just receive the question, then I will make a 1-minute video to answer that question so that hundreds or thousands of people can also get the same answer. So Bert is basically a Q&A. Then I try to make it more fun and interesting. So that's...
Okay, thanks for the comment. Next one. Inflation is high and rate hike is coming and market is fearful, but I'm more fearful of my money losing value in the bank. Any response on this?
Yeah, so like now if you hold cash, then cash you will lose purchasing power. For example, after Chinese New Year, 鱼圆面起5毛，杂菜饭起价， everything also 起价. So everything also cost 50 cents more For my side I don't know your side, the food more expensive or not. Then you see HDB resale prices going up. So property prices also going up. So you hold cash is sure lose. So actually now the most risky thing to do is actually holding 100% cash. But if you want to hold a small percentage of cash, let's say 6 months of your expenses as a reserve, it is okay. You lose a bit of inflation to inflation, but at least you have some cash, you have peace of mind. But besides your emergency fund, you should remain 100% vested. Be it investing in ETF or investing in big tech. Your portfolio strategy should not change. You should not try to hold cash and time the market. Stay fully vested if you can. Then if in terms of inflation, you should look out more for companies that are able to rise their prices and they are not so afraid of inflation. For example, like I mentioned, big tech, they can raise their prices. So example, Netflix, I think last time was $12 or what, then they raised to now $1, $13. So every year they will go up by $1, their monthly fee. So they have the pricing power. So as inflation go up, their membership fees will also go up and their earnings will go up. So you are not affected by inflation by being vested in strong companies like this.
Yep. Thanks for the comment. I think I also discussed inflation or interest quite quite often in the group, right? So I have no more comment on this. I think these two comments, right? Master Leong and Boss Ong is my idol. Don't care the Berkshire's 4-paper tiger REIT. And then there's this question that asks, where is it just now? talking about Master Leong. Oh, just saw Boss Ong join the chat. Any hot tips for all of us here? I don't know, Boss Ong, are you there? Can you unmute and say hi to everyone? Yeah, maybe not convenient to talk, but it's okay. But Master Leong, what's the story of this? Because I'm not aware of this, what for paper tigery.
During last time, there was this paper tantrum during 2018. As a value investor, I seldom buy REITs because I'm not really a dividend investor. So for dividend investors, generally for the Singapore market, the basic strategy is you hold banks and you hold REITs to collect 4 or 5% dividend. So during the 2008, there was the tapering, so the fear of rising interest rates. So REITs actually corrected 20%. And I bought into 4 of the blue chip REITs, like Maple Commercial Trust, Capital Mall, Fraser Centrepoint, so all these are blue chip REITs. So and then after the REITs recover, I sold them off already. And now he's saying that I'm bashing REITs and that I'm negative on REITs. The fact is that REITs is actually a property segment. And for property, there are cycle, up and down cycle, like depending on the economy and depending on the interest rates. So not only can you buy and hold REITs for dividends, sometimes you can also buy and sell REITs as a value investor, or depending on their movement. So I do not feel REITs are undervalued. So I no longer hold any REITs. Yeah. But let's say if REITs, they drop a lot and the yields are high, they pay a 6% or 8% dividend yield, then you can purchase blue chip REITs. Then I might consider going back into REITs also. So it's hard to say one. Yeah.
Master Leong, do you feel that REITs have some more downside, given that interest rate hikes are on the horizon?
Then the REITs actually I will sort into 2 categories. One is the blue chip REITs, very solid one, under the Maple, Fraser, and Capital family. These are the REITs that new investors should hold because they have a track record and they are very well managed. For example, let's say you are renting out your property. So this kind of REITs, right, they have long lease and the price, all their rental is locked in already. Then 2 year, 4 year, 6 year, or so they will have a gradual increase in their DPU. Whereas there are also poor quality REITs, like we saw the Eagle Hospitality Trust. During the downturn, COVID at time, hospitality was hit. Then in the end, now the Eagle Trust suspended, then delisted, then investors, they lose everything. So there's high quality REITs and low quality REITs. And in a high interest rate environment, right, low quality REITs can go bankrupt. Like my sharing, I shared before, I experienced the global financial crisis. During the global financial crisis, 2008, as the interest rate went up, right, Sizen REITs, and the M REITs previously was called Arthur McCook. So Arthur McCook REITs and Sizen REITs, because these REITs, they were over leveraged and their interest rates were not hedged. So they were using floating rates or what. So these 2 REITs, right, they crashed almost 90%. So during a high interest rate and crisis environment, REITs that are poorly managed, they could crash 90%. So you have to be very careful in your REIT portfolio. If you are trying to be greedy, you buy those small cap REITs that you think they are paying you 10% dividend yield, you must ask why the market so good, give you 10% dividend yield. Are there any other hidden risks? If you are not a smart investor and you're not a savvy investor, you buy into this kind of small cap REITs, and the bad times come, then it blows up. It can be like Eagle Trust like that. You could lose everything. So be very selective if you are picking REITs. Go for the higher quality one.
Thanks.
Hi, Boss Ong.
Hey, hi.
Welcome.
Hey, yeah, you were talking about REITs, right? Yeah, so I actually hold, what I think about REITs is actually I hold only the Maple, the big cap REITs like Maple 3 Industrial, Maple 3 Logistic, etc. REITs only. So, holding cash now is worthless, I find. So for me is to collect income and also do trading. So eventually if the risk went up above my initial price, I will just sell and I will wait, then I just recycle the money again and again. Yeah, this is what I do for my portfolio.
So do you
thanks.
Thanks a lot. So do you mainly invest in Singapore or you have positions outside of Singapore as well?
No, only Singapore.
I see.
Yeah.
Okay. Yeah,
I just
saw
hearing,
you.
you continue your section. I'm just hearing.
Yeah,
I
thanks.
just joined yesterday. Yeah.
Yeah, welcome to the group. Okay, let's move on to the remaining questions. These two questions, I'll link them up. If war happens, what companies will do well and what companies will tank? If war, buy dairy farm, Sheng Siong agree. Any insight or any opinions in regards to how to steer your portfolio given that war is coming?
So usually for war, if we look historically, usually like the Iraq war, 9/11 terrorist attack or what, generally what happens is the crash happens before the war or on the war declared on the day itself. So usually the stock market risk assets will be sold down and the money will be moved into safe assets such as gold, risk-free government-rated AAA bonds, government bonds, and cash. So now there's a lot of fear and some investors already moved to cash and defensive stocks. Yeah, but generally, it is not wrong to rebalance your portfolio. Example, you have a lot of high-risk stocks, right? You can rebalance. Let's say, example, you have a REIT portfolio. Example, you are half blue chip REITs and half small cap REITs. You can shift more towards your blue chip REITs. Allocate more towards like Maple, Fraser, and those capital brands of REITs that are more solid. Same that if you have a tech portfolio, example, you are half big tech and half those non-profit high growth tech, you can shift more towards big tech and hold less. So basically, you should shift towards more defensive if you are afraid of war and afraid of recession. So that is the proper portfolio management. So de-risking.
Yep. Thanks a lot. Yeah, I think with regards to war, right, I think maybe keep it simple, right? You can look at your portfolio and understand their business and see and ask yourself whether they will be affected by the war. For example, I have Apple, Amazon, Microsoft. So my question is, if really there's a war happening in Ukraine or anywhere else, right, would people actually stop using iPhones or stop using Microsoft Windows or stop using computer? Right. I think that's the question, right? If there's no impact, then I'm happy with my portfolio. Then I will just hold on. But let's say if there's a war happening in Taiwan and then suddenly bomb dropping there, and then I see that it will affect the supply chain of all these companies, right? I don't know. Maybe de-risk is a good strategy if that really happened, right? So I don't know, but all this war happening in Ukraine, I don't think it will have an impact to those who have investment in Singapore or in US. So keep it simple. Okay, let's move on to the next. I think I'll just combine these two questions. I guess people are asking Master Leong, how much cash do you hold? How many positions in your portfolio? And the second question is, can advise when to take profits personally for you, 50, 100 or 200%?
For me, right, my portfolio is zero cash, 100% vested. Then, like say, real cash in my bank account, usually I keep like 10 or 20K cash in my bank account to cover my living expenses. Every month, I only spend $1,000 as living expenses. So I try to hold as less cash as possible because of inflation. Then, what's the other question? To position your... Yeah. So how to position portfolio depends on your strategy, whether you are...
How many positions?
Yeah. So depends on your example, you are dividend investing, you want to be diverse, right? You want to hold a basket of risks, a basket of banks, then you want to collect, like say, construct a portfolio that gives you 4 or 5% dividends. Then let's say you are into like, so in the end, how many stocks in your portfolio also depend on your conviction. You see like Chicken Genius, all in Tesla, and it has worked very well for him. But will it work well for other people? The answer is no. Because for most people, right, if let's say your portfolio is $100,000, you put $100,000 all in Tesla or $100,000 all in Alibaba, can you sleep well at night? The answer is no, because you will feel very stressed. So at the end of the day, you should spread your money among different companies in the sense that you can feel comfortable holding. Example, you are spread your money into 10 different companies. So each of them, your exposure is only 10%. So if one of the company go bankrupt, you still have 90%. So you only lose 10%. You still feel okay. But if you put 100% into one company, what happens if the company go bankrupt? Can you take it or not? If you cannot take it, then you should not be so focused fire. So in the end, how many positions in your portfolio depends on the strategy and risk appetite. Yeah.
I think the next question is on taking profits, like when to take profits personally, 50, 100, 200%.
So when to take profit depends on your strategy. Example, I'm a value investor. I buy great companies when they are undervalued and I sell when they are overvalued. For example, I give you one example. Like during 2020, DBS, it crashed from $24 to a low of $17. So DBS historically it trades at about 1.2 times book value. So I started to buy DBS when it was trading at 1 times book value, which is about the $20 level. So I bought 8,000 shares at average price $20 at 50 cents because I believe at 1 times book value, DBS was undervalued. So when DBS rebound to $30 at 1.5 times book value, I felt that DBS was already fairly priced. So I sold off all my DBS shares at $30. So when it's overvalued or fairly priced, you can consider selling. When it's undervalued, you want to buy. So like for Alibaba now, I feel that the fair value, let's say, is $200. So for Alibaba, I bought at 220 and I bought all the way down at $130. So when I believe that it is fairly priced or undervalued, I can go in and buy. And if it's undervalued, I want to buy more. So if let's say Alibaba goes up to $300, then I feel that the fair value is just 200 to 250, but market is pricing it at $300. I think Alibaba is overvalued. So I might sell some Alibaba shares if it's trading at $300. So buy when undervalued, sell when overvalued. Yeah.
Yeah, thanks a lot for the comment. Okay, I'll comment a couple of questions here. This question, what is your opinion on NVIDIA? I think next week we will have YCX with us and then we can discuss NVIDIA in more details. So I'll just skip these questions. And then the next question, I also know that this is not from Nameless because I look at the list, right? Nameless is not here. He's not even in a group. So for your information. But let me just read it out and give my comment. What is percentage of your portfolio down year to date, and what is your plan if market keep tanking a few months? I think just now Master Leong also explained already, right? I think heavy into Alibaba, so you can look at Alibaba share price to know what is his return year to date. And then he also mentioned that if it really drop to a level that is so low that will risk the margin call, right? Then Master Leong is okay to de-risk and sell a portion of the shares. So I think this is also answered. Then the next one, do you want to know when market will start to rebound? What will you do if you know when market will start bull rally, buy, hold, or in? Honestly, I don't really understand these questions. Anyone know like what is all this about? And if not, we just skip because I can't comment. Okay, no, not to understand. So I'll just skip this. The next one, I saw Munger say e-commerce retailers aren't that entrenched compared to Apple and stuff, and they have lots of competitors. Why he buy Alibaba? You want to comment on this, Master Leong?
Because like, for example, US tech and China tech is different. US tech, there are monopolies. For example, Apple and Google, they are monopolies. That you want to use the phone, you either use iOS or you use Google. So they will sure 包价 your money, sure earn one. Whereas in China, there is no real monopoly. If you are a monopoly, the CCP will crack down on you and break you up so that there is real competition. So the Chinese and the US environment is a bit different. Then for the e-commerce landscape in the China, there is Alibaba, JD, Pinduoduo. These three are the main players. Then the upcoming rivals are Kuaishou and Meituan. Kuaishou and the Douyin. Kuaishou and Douyin are actually the short form video, but they are entering the live streaming segment to also sell products online, like beauty and healthcare products, which the influencers, they sell to their followers. So the e-commerce segment in China is getting more competitive. But why Charlie Munger still buy Alibaba? Because China as a whole, the e-commerce cake is getting bigger. From now until 2025 or even 2030, e-commerce will continue to grow. So let's say in the next decade, right, e-commerce will double in the size. Also, the cake is getting bigger. Although instead of 3 people, there are now 5 people eating the cake, but they will still each get a bigger slice of the cake. All 5 e-commerce players will still see the revenue growth. And Charlie Munger buy Alibaba not purely because of the e-commerce business. Well, Alibaba is actually a very big conglomerate, or is market leader in e-commerce, logistic, payment, and also and also cloud, and also cloud computing. Then also Alibaba got other smaller businesses that they don't really show, like semiconductor and AI. So it's actually a very big conglomerate. Alibaba actually owns stakes in 100 over different investments, which mostly are tech companies. So Charlie Munger is just trying to buy a basket of tech stocks, which he feels is undervalued. So be it Alibaba or Tencent, so they are actually mini ETF. The example, Tencent actually, they own stakes in 700 over different companies. They own stakes in Meituan, Pinduoduo, JD. Then they also, Tencent also holds a 5% stake in Tesla. So all these big Chinese tech companies, they actually hold stakes in a lot of other different tech companies. So you're actually buying a basket of tech. So what Munger is buying is actually buying a basket of tech stocks that he feels is undervalued. Yeah.
Yeah, now no more JD already dispute out. So no more. Yeah, okay. Thanks a lot for the comment. Actually, I'm very interested to hear, coming Berkshire Hathaway meetings, right? Because I think during the Daily Journal meetings, people ask Munger like why he bought into Alibaba, but we haven't seen Berkshire bought into Alibaba, right? So I think in Berkshire meeting, people might ask him like why Warren Buffett don't want to buy into Alibaba, right? I think this one seems to be there's some differences between the two gurus there. So quite interesting to hear. Okay. Next question. Thought on March FOMC meeting. So I think for this one, right, I'll just say you can check the CME rate hike, look at the probability. What I have been observing is that the percentage, right, is keep on changing, and it seems that the traders, they are not sure on whether there will be a 25 or 50 basis point. So this is quite interesting, looking at, when they are unsure, then you can see the stock market also getting a bit shaky. But once investor and traders, they can see a clarity in terms of the rate hike, how it will move, right? I think it will be good for the market as well. And this round is not just about the rate hike, and because around, I think mid of the year, they will also announce like how they will pare down their balance sheet. So, the mechanisms, right? How much they will reinvest and so on. So that one will also affect the bond market as well, because how much they reinvest or how much they let the central bank balance sheet just roll off, right? It will affect the pricing of the treasuries, which then will affect the yield curve, which then will affect everything else, right? So I think people are still waiting for more clarity on this. So that's a short comment on this. Anyone want to comment or any clarification questions?
Also, I think a lot of people are worried about the rate hike. So in March, it's sure hike one. It's either 25 or 50 basis point. But now the conscious from analysts like Goldman Sachs, Bank of America, JP Morgan, more and more analysts are leaning towards a 50% rate hike because they feel that the Feds are behind the curve. They should have raised by 25 basis point in the previous meeting. So they are behind by one hike already. So this time, the analysts expect the Feds to raise by 50 basis point or to jumpstart the rate hike. Then afterwards, subsequently, all the Fed meeting is alive. Live meaning that they are likely to raise the rates. So most analysts in the beginning of the year, they expect 4 rate hikes for 2022. Now, most of them, they're expecting 6 or even 7 rate hikes. So generous conscious is the interest rate are going to move higher and faster than what we expect. Yeah.
Yep. Tightening coming. Scary stuff. Okay, let's move on. Anyone let others invest your money? Got any great fund managers, minimum sum to join? Anyone want to have any ideas?
In Singapore law, you need a MAS license to be a fund manager. So if you let your friend, let's say you pass your friend $50,000 to manage your money, right? You can land your friend in jail because the MAS law is that to manage any fund, regardless of amount, you need a license. That's why the Singapore financial industry is so reputable, because there are a lot of rules and regulations. There has been a history throughout this decade that those people who sell course, right, they sell course already, then they don't find themselves making money. So they ask their student to put money with the sifu. Then in the end, the sifu take the money and they speculate, because there's profit sharing. If the sifu make money, the sifu can take 20% cut. Then if the sifu lose money, he lose the student money. There's no downside. Also, example, you give me $1 million. I take your $1 million, I all in wet Palantir. Palantir go up to $20, I make money, I get my cut. Palantir go to zero, lose your money. So it's very dangerous to let people manage your money. So don't let other people manage your money. If you want to get proper fund manager, just buy the ETF. ETF is or you can buy those unit trusts if you want proper people to manage. Then the minimum sum is there's no minimum sum. Just use those robo investing or what. So take care.
Yeah, I think put your money with all this ETF is also considered managed. It's just that instead of managed by a single person, now it's managed by the entire market. Because the entire market, right, they will take into all the information and just have a price on every companies, and they have the market cap, right? Then it just allocate according to that market cap. So it's in a way it is managed, but managed by everyone, by the collective wisdom, So that's why it's quite powerful, very hard to beat. Okay, let's move on. I only hold 5 stocks in my portfolio: Microsoft, Costco, Apple, Berkshire, and Visa. I think enough diversification, but yet focus on the best quality for long-term investment. Yeah, I think this is not a question. And all these companies looks very strong also. I think that's a good strategy. As long as you are not like having 5 names, but actually one of them having like 90%, right? So that's not diversification. But as long as they are more or less about the same size, right? This is like 5 names, right? You can have a very diversified portfolio already. More than that is actually what Munger said, adding egg to your beer. So you definitely don't need that. Anyone want to comment on this statement? If not, we move on. Next one. How come STI so strong this year? Master Leong, your comment.
STI is actually basically STI is a bank index. DBS, OCBC, and UOB. These 3 banks alone make up 45% of the STI. So STI is basically our 3 banks, then plus some other those cyclical stocks like property and also mix some REITs. So STI is strong because of the banks. But the banks now they are trading the valuations is not cheap like 1.6, 1.7 times book value because everybody priced in that they will benefit from the rate hikes already. But still, generally, as Singapore market is the market that you want to buy dividend stocks. It's still the place that you want to park on bank and REITs to collect dividend. That's the basic strategy if you want to invest in the Singapore market.
Yep. Thanks a lot. I think definitely interest rate hike will be helpful for the banks. So I think I will stop here in terms of answering all these questions. I will just quickly go through these ETF sheets that I want to share. I know that there are some people, including those in the YM65 group, right? They have been hearing Mr. Lu say that, okay, you can buy S&P 500 and just S&P 500, right? No need to invest. Don't stock pick. I think that's his message. But many people, they actually don't know which ETF to buy. So actually, I just prepared these 1-page things. I will just quickly go through that and then I will share the spreadsheet. So I think in general, when it comes to ETF, right, there's some echo. Can you please unmute? Yeah, so in terms of ETF, I think these are the key factors that you should pay attention to. I will just quickly go through each of them. The first one is, of course, the index, because each ETF, they will, except for those active ETF where the decision is all based on the manager alone, right? But for a passive ETF, they will have an index. So, you just read the index name, you have an idea on what was the strategy. So that's one. And then, based on the index, you will know whether they are invest in specific geography. For example, like S&P 500, only 500 companies in US. If you invest in MSCI World, that's like the entire global developed market, and then if it is emerging market, that's emerging markets, right? So you need to understand, look at the index first now. And then aside from that, there will be some index that will specialize into certain strategy. For example, there are passive ETF that invest in value stocks. So they will do some ranking in terms of their P&E, price to book, and so on, right? And then they will invest in those companies that looks cheap, or even some focus on momentum and so on. So those are also, there are such ETF around. And then lastly, there are some ETF that is specific to certain sector. For example, those who want to invest in semiconductor, but they don't know which companies to pick, right? They can always go for this sector ETF. But here, I will just mostly focus on the broad-based ETF, meaning that those invest in certain geography, but they invest in every sectors and just according to the market cap. I think that's usually the case. So that's number one, look at the index. The second one is looking at the domicile. So I think this one, mainly there are two. One is for those like US listed stocks, and the other one is actually this is not UK domicile. There's a typo here. It should be Ireland domicile ETF. Usually they are listed on UK London Stock Exchange. So the reason why some prefer to invest in Ireland domicile ETF is because the withholding tax is much lower. It is at 15% instead of 30%. So if you invest in, let's say, SPY, which is listed in US, right, for all the dividends that is declared, you actually have to pay 30% withholding tax now. So you don't have to declare that. I think the brokers will just keep the 30% and they will pay to the US government. The remaining 70%, it will be paid out to you. So that is the case if you invest in US stocks. Then the rest, the next one will be like liquidity, right? You know, for example, like one of the S&P 500 index is the S27. So that one is listed on Singapore Stock Exchange. But one main criticism is that the S27 ETF is very illiquid now. So if you look at the trading volume on the Friday, right, which is like 2 days ago, there's only like 123 shares that has been traded on that day. So you need to be careful for those ETF that is very illiquid, because you must use a limit order if you buy such an illiquid instrument. It could be shares or it could be ETF, right? If it is very illiquid and the bid-ask spread is very wide, right, then you have to place limit order. If you place a market order, right, sometimes the spread is so high that you actually overpaid for the price now. So you need to be careful on that. But whereas, let's say if you invest in US listed ETF, for example, like those SPY, VOO, because it's very, very liquid and the trading volume is so high, right, actually, if you place a market order, it doesn't really matter because the bid-ask spread is very thin. So I think that's the advantage. If you are someone who, let's say you do your manual DCA every month, what you want to do is just like beginning of the month, you just want to log into your brokerage account and then just place a buy order, right? And you want to make sure that it will be executed, right? You can place a market order, but make sure that you invest in those very liquid ETF now. Then the next one will be the price per share. I know some new investor, they want to do DCA, but they don't have, let's say, like $1,000 or $2,000 to DCA every month, right? They can only buy, let's say, like $200. So if the ETF price is more expensive than $200, let's say it's at $400 or $500, right? They can't buy it every month. So that will be a problem, right? So two ways to do that is, number one is that you can, instead of DCA every month, you can actually do it like every 2 months or every 3 months. So you can skip that. For example, like January, March, May, July, you buy every 2 months or buy every 3 months to achieve the DCA. You don't have to strictly follow the every month kind of approach, right? That's one way to do it. Another way is that you can buy into like US listed ETF because that will actually if the broker allow you for fractional shares, right, you can actually buy in fractional. So I think that's quite helpful as well. So these are consideration as well. And lastly, I think is the fee. I know there are people who comparing the fee, right? For example, should you buy do passive investing using endowers, or should you actually do your DCA yourself? I think you need to pay attention to the fee, because even if the fee is, let's say, like 0.7, 0.9%, right? I think this is can make a big difference if you compound it over time and your portfolio become very big. So I think definitely pay attention to the fee. I think these are the main considerations. And I think this one, I'll just quickly go through the list of ETF that I have compiled here. I think I will just share the spreadsheet, so you don't have to do your screenshot here. Just ask, you can ask in the Telegram group, right? I'll just provide the link to this spreadsheet here. So I've compiled some information. For example, you see their AUM, when is their inception, and then what's the expense ratio, and then the fact sheet is all here. I think this is all quite helpful for those who are like looking to compare like which ETF they should look for. I think just to summarize, although we have a long list here, right? I think just to keep it simple, right? I think CSPX, this is the one to go for those who want to adopt like a buy and hold approach. And because of the 15% withholding tax saving, right? I think CSPX is the one to go. This is, I mean, over a long period of time, you can likely save quite a fair bit of fees by using the CSPX. If this $450 is a problem for you, then I think VUSD is also good. I think these two are the best. For me personally, I have CSPX. And then for those who want to buy into others, for example, like between, let's say for NASDAQ, right? Let's say in terms of difference in the withholding tax, I think not much difference, because QQQ, they don't pay much withholding. They don't pay much dividends. So the 15% of the withholding tax actually don't have a huge difference. But the main difference is that if you buy into, like, for example, this CNDX, right, which is a UCITS funds, right, actually they are not subject to the inheritance tax. So for example, let's say touch wood, right, if you pass away, I mean, if the asset is in US, then it is subject to the inheritance tax. So that one could be a huge numbers. So I think that if that's a concern for you, then you can go for CNDX. But if not, I think QQQ is much better in terms of the trading volume. Like you can see the trading volume is quite a huge difference, right? So if you place an order on CNDX, I would say remember to place a limit order. Then the rest, I think, is really optional, because, you know, for some people, they prefer a VWRA just to have allocation to every countries. I think that's fine as well. And if you want to invest globally and you don't have a brokerage to access to those listed on London Stock Exchange, then the equivalent one should be the VT ETF. I think this one also entire world. So you have, like, you know, 9,000 holdings here. So almost every companies you will have exposure to. I think this is just a quick summary for those who are interested to look at which ETF to invest. And the time now is also 12:30 already. Let's come back to the Slido here. Anyone have any like burning questions to ask Master Leong, or anyone here? You can just say something. If not, we are close to the end of the call already, because it's only 2 hours. Okay, if not, right, then I would say thanks a lot to Master Leong for joining the session. And even though, you know, there are so many haters comments, right, which I think don't do that. I mean, for anyone who is posting all these things, right, we are all here just to exchange our view. Doesn't mean that, because you see, Master Leong also is not like accepting any fee or any things, right? It's just like sharing his view, right? So I think we all should be nice to each other. And thanks a lot to Master Leong, Gavin, and to everyone who is joining the sessions here. Appreciate all the comments here.
Okay, thanks for having me here. Okay, had a very good time. Don't worry, my skin very thick one. So you all happy can already. You all. Anything, just feel free to chit chat in the main chat. Feel free to ask.
Yeah.
Okay.
Yeah, appreciate your view, and appreciate that you take everything also positively. Yeah. Okay. Thanks a lot for joining. Let's end the call here. And see you guys in the next call and in the main chat. All right. Thank you. Bye-bye.
Hey, thanks all. Bye.